Welcome back to Index Investors. Today, we're going to start a mini series about value investing. We're going to test the very fundamentals of Warren Buffett's success. And of course, this is Jasper's door. So we're going to test and challenge some big banks and institutions. So we're going to add one more piece to our research and therefore to our knowledge that will bring us to build our money machine. I'm Alberto, and I help people and businesses alike to build the investing machine they need and deserve for their own goals. To do that, I use backtest, data, and of course, my own experience. So if you are ready to Gindex, welcome to Jasper's Door. What is value? Now, value can be defined in three ways when we talk about finance. Now, the first one is what we believe the value of a company is compared to its price. So if I had to buy a company, would like to pay less than what is the price, obviously, but also what is less, I would like to pay less than what is the actual value itself of the company. And there's different ways to calculate that. We're going to see that in a minute, but it's important to understand the first concept that price is not value. Price is what you pay for, and this is Warren Buffett. Value is what you get. Okay, this is very important. So that's definition number one of value. In finance, value can also be an investing strategy. A value investor like Warren Buffett, Charlie Munger, and all of those beautiful people. These are people that want to buy cheap and resell when the company goes up in value, and it worked out pretty well for them. I guess we can all agree on that. Also, value is an investing factor, and a factor, if you remember, is a series of characteristics that group similar stocks together. And those characteristics give those stocks a higher expected returns, which is exactly what we want as an investor. We want to make more money than we would get buying a global market index, for example. So this is supported by academic research. I will not dive into it right now, but obviously using Fama-French are involved into that. And also, if you look on Google Scholar, there's probably a few million results. That means there's at least a few million papers talking about it. And that is how far I'm going to push it. It's very well supported in finance and very well supported by research, but also very well received by the institutions and banks that are creating ETFs. There's a million different ETFs out there that is based on value. And you can go out and see what are the returns there, because you will see the comparison is pretty stark, I would call it. But before we get all of that, how do we calculate value? What is that makes something more valuable than the price you pay for it? And how do we do that with stocks? There are different ways to do it, obviously. Every single one of these is correct, but also every single one of this is not complete. So my approach would be like, let's test them all out. Let's test as many as we can, and this is the reason there's a mini series we're doing about value. And then we compare the results and we use the few that work better together. So we have a more complete view over what the value of a stock should be compared to the price, obviously. The most basic ways to do it is to compare price with assets, and that's the very famous price to book ratio. And what that does is simply compare what the price is compared to what the assets of a company are. This worked best back in the days where companies were more physical. So you could add up the value of the assets, such as the buildings, the factories, the machines. If you think about a company that makes transports, you can think about the airplanes, the trucks, the ships, and the patents, all of those things that put together are very easily to sum up and draw a line. And you can say, this is the value of everything you own. And therefore, if the price is lower than that, then we're buying a great company, or at least we're buying a company cheap for the price it is. Now, what that leaves out is how much the company is making, because if say you have a great company with 10 different factories, but they don't produce anything, they don't make any money. So yes, you're buying real estate pretty much, and you probably will make money when you resell that real estate, but you're not buying a great company. So that's why we sometimes use price to earning. Obviously, price to earnings is very famous, the PE ratio you heard about a lot, but you can use like price to sales or price to free cash flow in order to hear the same, to find out the same results. So how much a company makes compared to the price that you pay for it. As you see, like this is better probably nowadays because most of the companies have a component that is software that is not 100% physical and tangible. So if you have assets that are like a piece of software, for example, it's very hard to put it down in value, like in the first example with the price to book ratio, right? Then with the price to earnings, you see how much money they make, and you compare that to the price that gives you at least the capability to understand how much value in terms of output is the company producing, which is definitely a very good way to do it when you come up with tech companies and similar situations. And then obviously we got the Warren Buffett way, which is price compared to discounted future cash flow. What that means is simply like we know how much a company has been growing, we know how much a company has been making recently, so we project that in the future and we say, okay, this company will produce this amount of money in the future, and therefore I'm ready to spend this much to buy the company. And the idea is very simple. Warren Buffett says like a value of a company is how much money it will make for you, right? So you won't buy a company that you know will fail next year, even if they made a lot of money up to this point. If you know it will fail, you won't buy it. Or if you know this industry will suffer very much, you won't buy companies in that industry because the value they will produce will not be enough to sustain your effort, your expenses. How do we approach this? Well, this is Jasper's door, so we're gonna start challenging the banks as always. And the Morningstar is not definitely a bank, but what the work they do will support, and you will see it in a minute, the work they do does support a lot of the other big institutions. Particularly, it's used all around finance in order to give you a very quick snapshot of what an ETF contains in terms of stocks. Very quickly, this is Vanguard, the website. By highlighting the small section, you know immediately that this Russell 2000 is supposed to include small and growth stocks, right? Now, we have a video about small caps. I suggest you to see that video as well, because you will notice something very, very naughty about the Russell 2000. I'll just leave it there. Also, Fidelity is using the same kind of box. I see that obviously on the Morningstar website, and Henderson is using the same box. So what is this box? How is this box built? And what are we seeing? Now, this is the criteria that Morningstar used to build that box. And the criteria boils down to all these components here for the value, right? So they use 50% to price to earnings, price to predicted earnings, and then it breaks down to the other four down there. And on the opposite side, you can see the growth side of it. And again, they use all these ways, all these point of data in order to populate that box, right? And if everyone is using it, there must be something to it, right? Why then are these particular values important? So we can use and we can check if the banks are giving us the right information, right? This is what we do at Jasper, right? We challenge everything, especially if big banks tell us to do something or to trust them. We're going to challenge it. So the idea of this mini series is to go through each one of these values, each one of these points of data, and see if that is a good way to invest in value. And then we're going to have a second mini series about growth. If you like that kind of stocks, would that work? So all in all, we're going to start each single one of the Morningstar definition data points, and then we're going to want to understand if we can trust it. And of course, at the base of everything else, we're going to test if value it is a factor. If a company that is exposed to value will have higher expected returns. That's all we do in investing. Today, we're going to price the first data point, which is price to projected earnings. So let's get into that. In order to do it, we're going to create today's Gindex. And if it's your first time here, a Gindex is a DIY investable index and is an index that you create yourself in order to meet your specific goals, right? You will create an index that expose yourself to the factors that you want to get exposure to, with the size that you want to have, and also without paying any commissions to the big banks. Remember, the big banks' incentives are not aligned with yours 99% of the time. They want to make money out of you. They won't necessarily want to make money for you. And that's why we create our own indexes. For today, though, we're going to use a global, so that means all the data set of stocks that we have will be included. And we're going to create an Gindex by ordering those stocks for the value we selected, which today is going to be priced to projected earnings. If we flip that around, we're going to have a continuum of stocks from growth to value. And then at the top, we're going to have the growth, and at the bottom, 10%, we're going to see value. And then again, we're going to divide everything else in decile. So remember, each decile will contain the same amount of stocks. The only criteria that sort them out, again, is price to projected earnings. To build today's Gindex, we're going to use, again, we said it, is a global universe. So every stock in the data set, we do not make selection in terms of market. And the reason for that is, if this is a value, it will be true again across all markets. There's no USA or Europe that makes any difference. If it's a true value, if it's a true factor, it will be true across markets. And then we select randomly within the decile for each pass. Again, because this is a test of the validity of a factor, we do not make one single pass. We buy random stocks within the decile, and because all those stocks have the same amount, the same exposure to the factor or similar exposure to the factor, they must have similar outcomes. And that's what we're going to do today. Actually, what we're going to see today, what you're going to see today, is the results, is the median outcome of 5 iterations for each of those deciles. So in each decile, I ran 5 different Gindexes with these rules, and you're going to see the median outcome. In each Gindex, the number of stocks was 50, and the rebalancing time was every 6 months. Unfortunately, we don't have the usual 2000 to present time frame, just because I don't have enough data to support that time frame. We're going to have to start from 2009. And that is because it's very hard to come across the expected PE for a company back in time. It's just a data set issue. That's all it is. And as always, if you want to replicate this experiment at home, you can totally do it. The code is in the link in the description. You're going to jump on Jasper's door and you're going to see all the rundown for the experiment. All right, let's get to the data. Let's get to the interesting part of this thing. Call me a geek. I really like this part of the thing. So we're going to see today on this chart. First, you're going to see the first Gindex, or the first decile, compared to the fifth. Being the average of the fifth will obviously be a good comparison to the first and the 10th decile, which is also there. Now we expect the first decile to outperform the 5th and the 10th, and also we do expect, if value is an actual factor, the 10th decile or number 10 to underperform everything else. And as always, because this is science, we're going to have a control group. A control group is a index made out of random stocks out of the entire universe. And again, we run it 5 times, get the median in order to have something to beat. We already seen in the previous video, we cannot rely on the S&P 500, first because it only exposes you to big cap stocks from a particular market, the USA, and also because it turns out, if you see our first video, that random stocks do beat the S&P 500. Go watch that. It's pretty intense, let me tell you. So I'm going to run it now. I'm going to let you see and enjoy this, and I'll see you on the other side of the chart.
Yeah! Wait, really?
Yes.
Yes! I mean, it may be derivative, but it's the most successful campaign to come out of this agency in a long time.
Yes.
Yes, this looks very good. First of all, first decile value stocks, they do outperform consistently through the dataset, through the time as well, outperform the rest of the deciles, but also most importantly, it does outperform decile number 5 and the 10th decile as well. Interesting how the 10th decile had a good time, to be fair. It did almost outperform something up to 2020, and then it just crashed down in the recent year. Recent year have been a very tough spot to invest, very easy to perform well, but very hard to outperform. And again, 5th decile and random very close by. I wouldn't say the 5th decile will always outperform the random. I know it doesn't. But the fact that they come close together is also indicative that this is overall a real factor, as in 1st decile outperformed clearly, last decile underperformed clearly, and the random goes right in the middle there. In fact, if we switch to the next slide, you're going to see this is the compounded annual average return for each of the decile, and you'll see how the graph it grows very high up to almost 20% returns on the left side, 1st decile, and slowly decrease down up to the 10th decile. There's a bump in the middle there. I do not, well, obviously from this data, we cannot assert why there's a bump in there. It looks like kind of relevant. If you see the white dots of number 6 decile, they all spaced up nicely higher than the rest of it. And while we don't know exactly why that is from this kind of experiment, we can feel, my opinion is that there's more to it. There's more factors out there that we're gonna have to search and discover, and this is really exciting for me. I don't know if the nerd in yourself is excited about this, but exploring and finding out better edges is what we're here for, and this is what excites me. But again, let's focus on value for today, and we're gonna just point out how 1st decile and 2nd decile are actually outperforming everything else. And if you want to access that value, the value outperformance, you will have to pick the top 20% in order to have good results, or more consistent results if you want. There's a little bit of a mistake in this graph. At the very top, it says CAGR, but it's actually volatility. Now we're looking at volatility, and everything below 20 is what we want to see. Of course, first 2 deciles are the more volatile. That is actually fascinating, and to me, that it reminds me of human nature. You can see where the sharks are circling, where you can see where the action is. If something is very low priced, there's more action around it. And on the right side as well, you can see where the growth is happening. There's more volatility. To me, that's still a sign of human nature, because if everyone else is buying that particular stock, then there's more action. There's more everyone else. There's a herd mentality that pushes everyone else to go and buy it. And finally, we got the Sharpe ratio, which is pretty much the ratio in between the first two charts. And you can see how volatility is lower in the middle, pushing all the results up. Sharpe ratio, for those who don't remember, is a meter of returns, but also a meter of risk or quality. You want returns, but also you don't want to have massive volatile shocks in your portfolio, and the Sharpe ratio will help you measure that. So the higher the Sharpe ratio, the better you are. And I love to point out two things here. Obviously, we got the three things. We got the 10th decile suffering because of bad returns and bad volatility. In the middle, very low volatility pushes that little hump even higher. Just to be aware of the volatility of the results of decile number 6 that are all the way up to 0.7 in Sharpe ratio and all the way down as well. So that's a lot of volatility. Volatility in results that we don't have with the first and second decile. We got a very bad second decile. Something wrong has happened there. But apart from that, all the results are actually in there and are very, very, very well packed together, giving us a nice idea of how value is consistent in his delivery. So what do we learn? We learn obviously that the value factor is actually an investable strategy. But to access it, you need to access the top 20% of the stocks. That shows the value as a characteristic, as a factor. And among those data points that you can try and find and use in order to expose yourself to the value factor, price to projected earnings is a good way to approach it. So that's very important. Then we have one other piece that we can add to our puzzle, one other piece that we can add to our Gindex when we're going to create our own way to invest. Okay, this is what it's all about. We're going to have all those puzzle pieces. We know exactly what is working, what will work, and then we put it together in something that makes great investment strategy based on data, based on what we know. We do not want to learn this from Twitter, or we don't want to learn this from YouTube. We want to learn it from the data. So do not trust every single thing that you learn online. How does it compare? So outcomes, so value versus growth. Obviously, Sharpe ratio is much higher for value, but what comes out is also the compounded annual average return, which it's very high. But be aware, again, we're using data set from 2009 to present day, and we knew already before doing the test that data, that particular time frame is has very high returns for the entire stock market. So we know already that if we could go back in time, that average return will be lower. It's still significant, it's still very strong performance, and it still beat the random. So we know it's a factor and it works, but don't be impressed by the number in the vacuum by itself. How does that compare to the Gindex leaderboard? Obviously, with that kind of results, you have a very high position, and the volatility is still a little bit high, but the results are clear. If you did invest in the last 20 years, 29, it's 15 years with this particular approach, you would have very, very good results. You will be quite satisfied. Now, we're going to update weekly the Gindex leaderboard. And if you want to see the results and the entire Gindex leaderboard, just please jump on jaspersdoor.com/leaderboard. There's a link in the description if you hate typing. So what is the next step for this mini series? We're going to go through each of those data points that Morningstar uses to rank their values and see if all of them, if any of them, is good for what we need to do. And then from there, we're going to switch to growth and find out the other side of the medal. Is growth. Think with me, if value is a very good way to invest, and also we know that some people are investing in growth and having results, how is that happening? How is that a real thing? We're going to find out in this beautiful mini series that is coming up. If you want to learn how to get into all of this and you want to learn how to build your own investment strategy, we're going to launch a course very soon. There's a link in the description for that. And we're very proud of it because we're not going to just tell you what works in investing. We're going to make you an investor. This is our promise. We're going to make you an investor. In 7 weeks, you will come out the other side knowing exactly what to do with an investment portfolio open and with a support that will make you the best investor you can ever be. I'm Alberto, and you are on Jasper's Door.